Hi, my name's Kurt DeBerg, and I'm a professor of accounting at California State University, Chico. I've been teaching here for 28 years, and when I discovered how easily accounting can be taught using electronic spreadsheets, it blew my whole paradigm away. The old paradigm shifted to one of database management. And instead of assets always equaling liabilities plus equity, as we normally know it, I teach students that changes in assets minus the changes in liabilities and equity must always be zero. And with an electronic spreadsheet, we can build in a self-balancing system whereby students don't need to memorize any longer the 10 steps in the painful accounting cycle. If you've ever had an introductory accounting class, you probably had to memorize that you would identify a transaction, analyze it, make a journal entry in a general journal or a special journal. Then occasionally you would post entries to the ledger. And at the end of the accounting period, you would prepare an unadjusted trial balance. Then you would make adjusting journal entries at the end of the period. And then you'd make another adjusted trial balance. And from that, you would prepare your 4 financial statements: the balance sheet, the income statement, the statement of stockholders' equity, and of course, my favorite, the statement of cash flows. Then you would make closing entries, closing all your revenues and expenses, gains and losses, and dividends into retained earnings. And then you would make your post-closing trial, there that word is again, balance. Well, today, in the next 8 minutes, let me take you from the 10-step accounting cycle to the 3-step accounting cycle, which is to identify/analyze the transaction, record it in the database, and then use that database in any fashion that you need. Now that sounds probably pretty idealistic, but let me see if I can use the example that I used in the first video. And here in the second one, we're going to use Doe's printing business. And Doe's printing business has a chart of accounts. All assets begin with the number 1, all liabilities the number 2, all equity the number 3, and then all, I would say, temporary accounts. These would be changes in equity. That would be revenues, expenses, and dividends. So here we have a chart of accounts with our 5 assets there, our 2 liabilities, our 2 equity accounts, our 1 increase in equity from earnings, 4 expenses, which are decreases in equity this period. And then when the owners take money out of the business, we call that a dividend. So let's look at the transactions here. John Doe owns and is going to start Doe's printing business. And he contributes how much? He contributes $50,000 cash on January 1 to start Doe's printing service. And in his second transaction, he invests $30,000 in cash by buying some equipment. And so here's how we're going to post these transactions, not first into a journal and then to a ledger. We're going to record this first transaction into his database where cash goes up $50,000, account number 11, and equity goes up. His capital stock goes up $50,000. And notice our assets go on the left, numbers 11 through 16, and then our liabilities and equity on the right. And check this out. All changes in left in our assets, which start here at D6, all the way through J6, would be subtracted from K6 through N6. And there's our formula, and that should be 0. And of course, if we drag down on the drag and fill handle, we can always make sure every transaction balances. So look at transaction 2. Cash goes down just like a checkbook. It's a plus-minus system. Cash down, equipment up. And do we balance? Oh yeah, baby. If we had accidentally entered this as $3,000, we would be off by $27,000. We will never be off because our accounting system will not permit us to go on if we, the bookkeeper or data analyst, do not enter the data correctly. Transaction 3, what happens? The company buys $4,000 of prepaid rent. Cash down, prepaid rent up. What if this number had been 400 rather than a 4,000? We would have a number that's off. Oh, doggone it. Let's go back and fix that. All right. And of course, let's take transaction number 4 here. Let's see what happens. Let's give that a little more room. Transaction 4. We buy supplies with accounts payable. Debit supplies if we use 2 columns. Credit accounts payable if we use 2 columns. But here, increase the left, increase the right. All right. Next transaction, we would actually increase cash by 10,000 and increase retained earnings. And that's account 51. That's revenue, folks. Capital stock is equity contributed. Retained earnings is equity earned and not yet distributed. So let's go ahead and put this under revenue. Increase cash, increase equity earned. And now check this out. At the bottom of the page, every time income is affected, we correct or we adjust for that income item during the period. And right now we have net income of 10,000, which articulates with our balance sheet of 10,000. We currently have cash of 26, supplies, prepaid rent, printing equipment. We have accounts payable of 1,000, capital stock plus net income. Everything balances. Notice our balance in cash here equals our balance in cash in the statement of cash flows. So we have our balance sheet, income statement, statement of cash flows, and of course our statement of changes in equity is embedded as part of our balance sheet. This is awesome. Look at transaction 7. We actually sell $8,000 worth of services on account. Notice our income statement goes up to $18,000 of revenue. The balance sheet increases our equity by $18,000. And of course, cash is not affected. And that's important for introductory students to see. Transaction 7 is posted. What happened in transaction 7? We spent cash to pay off our account payable. Transaction 8, we spent cash to pay employee wages. Cash goes down, equity earned goes down. That's account 52. And notice, salary expense is part of our income statement. Our income has fallen now to 15 grand. It articulates there. And our cash now is 22 grand. Oh my gosh, I hope you're understanding how powerful this is. We can go through all the rest of the transactions. Let's go all the way to transaction 15 when we pay the dividend. Cash down, equity earned down, or retained earnings goes down. And that's account 61. Let's look at our balance sheet. We now have 42,000 in cash. We don't even have to add the cash column. We have how much of printing equipment? 30,000 less 500 of depreciation. Our income statement shows 33,000 of revenues. We have those 4 expenses. So our net income of 23,700 articulates right there. Our ending balance in cash is 42,000. Now that's impressive. If any one number was entered incorrectly here, we would have known and diagnosed that there was an error. So when our students come in and say, "Coach, my balance sheet doesn't balance," I'll ask them to do what I call a Pacioli check. Let's insert a comment there, and we'll call this a Pacioli check. And students love that command. And they also love the insert comment feature, where Luca Pacioli would have called the insert comment feature, he would have called this his waste book. And his waste book, well, I could explain that to you, but for now, let's just go on and we'll end this video by showing that with each transaction, we could actually prepare our current ratio, our return on equity, our debt to equity ratio. So my friends, when we add up all the columns here, we get the same number we had without having to stop and add them all up. We have real-time financial statements. I hope you've enjoyed this video and I hope it rocks your world. Thank you.